Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Southern Airlines Company Limited annual report. China Southern Airlines Company Limited offers a diverse range of businesses and services to cater to various needs of its customers. The company provides airline transportation services within China, Hong Kong, Macau, Taiwan, and internationally. In addition to air travel, the company also offers cargo, mail, and luggage transportation services. The company's services extend beyond transportation to include aircraft maintenance, operating agency business for domestic and foreign airlines, and airline catering services. It also provides aviation ground extension business, civil aircraft type training, asset leasing, engineering management, and technical consulting. Furthermore, China Southern Airlines Company Limited offers a range of retail services, including commodity sales, travel agency services, and health examination services. The company's business portfolio also includes telecommunication services, such as Internet Data Service, Internet Information Service, and value-added telecommunications business. Additionally, it provides advertising production, release, and design services, as well as socioeconomic consulting services, information technology consulting services, and import and export agent services. The company also manages hotels and offers tour services to its customers. In total, China Southern Airlines Company Limited operates in multiple sectors, including transportation, logistics, retail, telecommunications, and consulting. Its diverse range of businesses and services enables the company to cater to various needs of its customers and establish itself as a leading player in the industry. China Southern Airlines Company Limited market capitalization of $71 billion is materially smaller than most of its industry peers of roughly $101 billion. China Southern Airlines Company Limited trades at a higher price-to-book ratio of 1.68 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 84% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through an analysis of various segments within the industry. On the growth side, traffic revenue has been a significant contributor, with international passenger revenue increasing by 20.48%. This is largely due to a 19.57% increase in international traffic, RPK. Additionally, other segments such as ground services income have seen substantial growth, increasing by 50.06%. In contrast, the decline drivers are more nuanced. A decrease in commission income of 6.4% has been observed, while sales in advance of carriage have also declined from 92.95 to 87.96. Furthermore, other operating revenue has decreased by 0.8%. These factors suggest that a combination of internal and external factors is contributing to the decline in revenue. The growth drivers are largely driven by international traffic, which has seen significant increases in both passenger and cargo revenue. This trend suggests that the industry is becoming increasingly globalized, with international travel driving revenue growth. In contrast, the decline drivers highlight areas where the industry may need to focus on improving performance, such as commission income and sales in advance of carriage. Overall, the analysis highlights the importance of understanding the various segments within the industry and identifying key drivers of growth or decline. By focusing on these areas, stakeholders can make informed decisions about how to optimize revenue growth and mitigate decline. The net income of the company underwent significant changes between 2024 and 2025. On one hand, there was a notable increase in net income from RMB 25 million to RMB 2,683 million, representing a staggering 10,666% growth. However, this positive trend is not consistent across all reports, as another report shows a decrease of -27.6% from RMB 5,909 million to RMB 4,292 million. The operating profit margin also experienced fluctuations between the 2 years. While it increased from 4.8% in 2024 to 5.3% in 2025, according to one report, another report shows a more significant improvement from -0.41% to 2.18%. The net income margin followed a similar pattern, with an increase from 0.01% to 1.5% and then to 1.47%. The discrepancy in the reported figures suggests that there may be inconsistencies or variations in the data provided. However, it is clear that the company's financial performance improved significantly between 2024 and 2025, with notable increases in net income and profit margins. Based on the provided information, it is clear that the company is indeed generating positive operating cash flow. This is explicitly stated in the summary, and further supported by the specific figure of RMB 32,711 million in net cash inflow from operating activities, as mentioned on page 31. This significant amount of positive operating cash flow indicates a strong financial position for the company, allowing it to cover its expenses and invest in future growth opportunities. The fact that this is explicitly stated and supported by numerical evidence makes it clear that the company's financial health is robust. The company's debt level and interest expenses have undergone significant changes over the past year. According to the extracted summaries, non-current liabilities increased by 8.1% from RMB 114,219 million to RMB 123,119 million on page 4. However, a closer look at borrowings reveals that current borrowings have surged by 18.3%, while non-current borrowings decreased by 14.5%. This mixed trend is further reflected in the overall debt level, which increased by RMB 3,455 million from RMB 130,824 million to RMB 134,279 million on page 15. In terms of interest expenses, there are conflicting trends across different pages. On page 4, interest expenses rose by 21.3% from RMB 5,219 million to RMB 6,351 million. However, on page 9, interest expense remained relatively stable, with a minor increase of RMB 4 million from RMB 5,754 million in 2024 to RMB 5,758 million in 2025. Furthermore, on pages 12 and 17, total interest expenses decreased by -3.7% from RMB 5,758 million to RMB 5,553 million, with finance expenses and interest expense both decreasing. These disparate trends suggest that the company's debt level and interest expenses have undergone significant fluctuations over the past year. The performance of various airline transportation operations and regions was analyzed based on reportable segment revenue and profit after taxation. The airline transportation operations showed an increase in both revenue and profit, with RMB 180,649 million in revenue and RMB 1,642 million in profit. In contrast, the Hong Kong, Macau, and Taiwan region experienced a decline in revenue, with a growth rate of -2.06% in cargo traffic. The international segment demonstrated strong performance, with a traffic growth rate of 19.53%, making it the strongest performer among all regions. The domestic segment showed mixed results, with an increase in revenue but varying growth rates across different pages. Overall, the airline transportation operations and international segment performed well, while the Hong Kong, Macau, and Taiwan region struggled. That concludes the financial summary for China Southern Airlines Company Limited. Feel free to comment below, and I will be happy to answer them when possible.